quarter of 2020, with recoveries in the fourth quarters. The of the global economic recovery will depend in part on how quickly countries are able to open up for economic activity safely, and in particular, how effectively societies comply with social distancing rules. World Health Advice complications of the virus, and the pandemic is unlikely to end quickly, with the virus coming in waves over time. The crisis has caused extreme volatility in financial asset prices, with sharp and deep market sell-offs followed recently by a partial recovery. Investor interest in higher yielding assets has improved in recent days, but the general environment reflects pronounced levels of risk aversion, in particular for emerging market currencies, equities, and bonds. Uncertainty about future global economic prospects, relationships, and supply chains has increased again. Policy responses have generally dependent on the degree of policy space available to countries. The US Federal Reserve has taken further steps to expand its balance sheet, and the European Central Bank has made similar commitments. Emerging and developing economies generally have less policy space available, and credit is more expensive. The international financial institutions have made available extraordinary levels of emergency financial support to respond to COVID-19. The COVID-19 outbreak has major health, social, and economic impacts, presenting challenges in forecasting domestic economic activity. The compilation of accurate economic statistics will also remain severely challenged. The bank currently expects GDP in 2020 to contract by 7% compared to the 6.1% contraction forecast in April. Even as the lockdown is relaxed in some coming months, for the year as a whole, investment, exports, and imports are expected to decline sharply. Job losses are also expected to be widespread. Easing of the lockdown will support growth in and some high activities show a pick-up in spending from extremely low levels. However, getting back to pre-pandemic activity levels will take time. GDP is expected to grow by 3.8% in 2021 and by 2.9% in 2022. South Africa's terms of trade remain robust. Commodity export prices increased in recent weeks, but are still at healthy levels. Oil prices remain low. The spot price for Brent crude oil is currently around $34 per barrel and is expected to remain around these levels in coming months, contributing to reduced petrol price inflation. For our forecast, the Brent crude oil price is expected to average $37 per barrel in 2020 and $45 per barrel in 2021. Exceptionally accommodative policies and the relaxation of lockdowns in many advanced economies have supported a partial recovery in global financial markets. But financing conditions for emerging markets remain uncertain. Domestically, credit with public bonds needs remain very high, contributing to non-resident investors sales of about 149 billion rands of local currency denominated assets. The rand has depreciated by 22.9% against the US dollar since January and by 0.7% since the April meeting of the MPC. The implied starting point for the rand is 18 rands 40 to the US dollar, compared with 17 rands 80 at the time of the previous meeting. Resident investors have increased purchases of long-term bonds, helping to ease yields in recent days, but the yield curve remains exceptionally steep. The bank's headline consumer price inflation forecast averages 3.4% for 2020 and 4.4% in 2021 and 2022. The forecast for core inflation is lower at 3.5% in 2020, 3.8% in 2021, and 4.1% in 2022. The overall risks to the inflation outlook at this time appear to be to the downside, but less clearly so compared to conditions in March and April. Global producer price and food inflation appear to have bottomed out. Oil prices remain low, but have recovered somewhat. Local food price inflation is expected to remain contained. Risks to inflation from currency depreciation are expected to stay muted, while pass-through remains slow. However, electricity and other administered prices remain a concern. Upside risks to inflation could also emerge from heightened fiscal risks and sharp reductions in the supply of goods and services. Expectations of future inflation soften, but remain around the midpoint of the band. Market-based inflation expectations for short and medium term have fallen, while long-term inflation expectations remain higher. Despite sustained higher levels of country financing risk, the committee notes that the economic contraction and slow recovery will keep inflation well below the midpoint of the target range for this year. Barring inflation risks outlined earlier, inflation is expected to be well contained over the medium term, remaining close to the midpoint in 2021 and 2022. Against this, the MPC decided to cut the repo rate by 50 basis points, taking it to 3.75% per annum, with effect from the 22nd of May 2020. 3 members preferred a cut of 50 basis points, and 2 members a cut of 20. The implied path for policy rates over the forecast period generated by the quarterly projection model indicates 2 repo rate cuts of 25 basis points in the next 2 quarters of 2020. Monetary policy can ease financial conditions and improve the resilience of households and firms to the economic. In addition to continued easing of interest rates, the bank has eased regulatory requirements on banks and has taken important steps to ensure liquidity in domestic markets. These actions are intended to free up more capital for lending by financial institutions to households and firms. Monetary policy, however, cannot on its own improve the potential growth rate of the economy or reduce fiscal risks. These should be addressed by implementing prudent macroeconomic policies and structural reforms that lower costs generally and increase investment opportunities, potential growth, and job creation. Such steps will further reduce existing constraints on monetary policy and its transmission to the broader economy. Global economies are expected to remain volatile in this highly uncertain environment. Future decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second round effects. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes our statement, and we are in unusual times, and I hope that you will be able to use the technology. You can raise your electronic hand by using the facility on this platform, or alternatively, you can type your question on the chat group of this meeting. We are open now for questions. Anybody there?
Hi, Gabrielle Steinhauser here from the Wall Street Journal. Quick question, with the CPI release delayed, and you said there's sort of difficulties in gathering data for economic indicators, how hard has it been for the Monetary Policy Committee and your staff to make predictions for inflation and other indicators going into the future? So if you don't know what the economic picture is now, and we're facing an unprecedented crisis, how are you able to sort of tell us what's lying ahead and make policy accordingly? Thank you.
Thank you, Gabrielle. Any other questions? I would like to take two more at least.
Hi, Governor. It's Mariam Issa from FinWeek. Can you tell us whether you expect the economic recovery to be V-shaped, or is there any chance it will fall below 3%? And are you still buying bonds now that the market is functioning better than it was before?
Last one.
Governor, it's Pranisha from Bloomberg.
Yes, Pranisha.
Why 50 basis points? Did you discuss a cut by a bigger margin? And when it comes to your bond buying program, do you assess its effectiveness?
Thank you very much for those questions. Gabriela, the uncertainty of the data, if the release is postponed, it does not necessarily affect the forecast that we have. There are, however, measurement issues. I think Stats SA had stated that the coverage might be lower than it had been in the past. So that might not impact our forecast, but it would impact the actual measurement that that actually comes out. In this respect, we are not alone. All countries are facing. Most countries are facing exactly the same situation. And as we have stated in the statement, these are uncertain times, and these uncertain times are actually making economic forecasting very, very tricky. In our situation, you have the lockdown, there are whole industries that have been shut down. What price were they going to sell? So we are going to have to wait for Stats SA when they come out with the figure. There are a number that statisticians would face with a situation like this, and I think that we would wait for Stats SA to tell us that. The forecast that we have now has incorporated all of the data that we know to date, and we had to make assumptions about the future trajectory of other data, but that makes it really, really difficult, as you correctly pointed out. I'm very good with the alphabet. This would be V-shaped. People are V-shaped recovery, a U-shaped recovery, W-shaped recovery. People of an L-shaped recovery. As I said, when forecasters start to give you letters and not numbers, that tells you how uncertain the forecasting environment is. Because you see, with a letter, it doesn't matter. As long as you have given the letter, the numbers do not seem to matter for you as long as they fit the letter. I do not think it is very useful to talk about those letters. We have put on a forecast now, and that forecast has got risks. And what we do know is that there had been a significant slowdown, and actually we say that a contraction as a result of this supply and demand shock that we have seen from COVID-19, and the appropriate responses that governments across the world have taken of going into a lockdown. So I cannot say to you what shape the recovery would be. Suffice to say that there will be a recovery next year, and we can always argue about the figures. Inflation falling below 3, that is not in our baseline. It is possible going forward that you might have a month or two where inflation might fall below the 3%. Treated in the same way treated it when inflation on some months went above 6%. Put simply, we will see through the shock and see whether there are any second round effects that come from that inflation outcome. And if there are second round effects, monetary policy will respond to those second round effects. The bond purchases, as you have correctly pointed out, we are doing the bond purchases in to smooth the functioning of the market. And so if we talk about how effective they had been, we have seen that they have actually been effective because the market continue to function. And let us be clear, we entered the bond purchases program with a clear intention of getting the markets to function in accordance with our mandate. The functions of the Reserve Bank is to ensure functioning financial. And when we saw a dysfunctional functionality in the financial, we embarked on that bond purchase program, and it looks like the markets are functioning quite well. We stand ready to deploy our tools should see that there is any dislocation that is taking place within the market. So if effectiveness has to be in terms of what they intended is getting the markets to function and for price recovery to take place, yes, it has been. Prudential, you asked of a higher or a larger policy rate.
And so we apologize about the quality of that transmission. It appears that the governor's Wi-Fi perhaps is not as stable as it should be. That announcement that the MPC decided to cut the...
We convince each other, and in the end we say, I have heard you, and here is my position. And what we have captured here in the statement saying that 3 members preferred a 50 basis point hike and 2 preferred a 25 basis point cut, we decided to go with the 50 basis points cut. Any other questions? Rashad, is there anything you would like to add on that statistics and data? Okay, any other next questions? Lucanio. Lucanio, your microphone is muted.
Okay, you can hear me now, Governor. Good
Yes.
afternoon, Governor. Governor, I also
Yeah.
just wanted to follow up with the question regarding the bond purchases. You sort of half answered it a bit, but I wanted to check. Now you say there's calmness in the market. Is that a sign that the policy has worked, or is that a sign that you are still heavily active in the market? So I'm trying to get a sense whether or not you're as active as you were last month, for example. And then secondly, on the issue of members voted for 25 basis points, and I'm just wondering whether we should read that as an indication getting the point where it feels it has done sort of the stimulation that is time activity. Governor.
Thanks, Lucanio. Other question?
Hi, Claire. Can you hear me?
Claire?
Yeah, can you hear me? Hello?
Yes, Claire. Yes.
Yes. Do you have any in-principle objection as the MPC to the real policy rate turning negative and remaining so for a long, prolonged period? And also, do you have any in-principle objection to the nominal policy rate falling below the 3% lower end of the target range?
Thank you, Claire. Okay, so Fundi, you wanted to add something, or Chris, you wanted to add something on the previous question on CPI. Chris Lovald, are you there? Unmute yourself. Okay. Let me take Hillary. Hillary, your electronic. Unmute yourself, please.
To unmute. Governor, nobody actually asked what quantity of bonds have you bought in May? You had given us an April and a March figure, but if you could provide an update on the May figure, it's almost the end of May. A non-monetary question as well, directed, I suppose, to the Prudential Authority. What are you seeing in the banks in terms of overall applications for assistance, not just under not the credit guarantee scheme yet, but the bank's own programs of payment holidays and so on? Are they reaching concerning levels, and what are the banks in terms of default levels at this point, 2 months into the lockdown? Thanks.
Chris Lovald, you can unmute your microphone.
I can.
Yeah, I can hear you now.
I think I'm on. Okay, I just wanted to say on the inflation forecast coming below 3, we don't have that on an annual level. Someone's saying to me, stop my video. Okay, we don't have that happening on an annual basis, but we have 2 quarters this year of headline inflation coming out below 3, 2.8, and that's quarterly, Q2 and Q3, and it's entirely driven by very steep deceleration in petrol prices.
Okay, thank you. Whilst you are at that, Chris, why don't you deal with Claire's question about the repo rate, real repo rate being negative or the nominal rate being below 3%?
Sure. Yeah, I mean, the real rate on the forward-looking is negative. to about 6 negative. So that's the real rate level 4 quarters ahead, which is one of the ways in which we think about the transmission time duration for monetary policy transmission. So we use 4 quarter ahead as one way of understanding what the real rate level is. On a contemporaneous basis, it's around 1. If you look at the real rate level relative to our neutral, it is very strongly negative. So our neutral real rate is 0.1%. And use a forward-looking real rate, then you get down to a very large negative real rate. And that negative real rate stays that way through to nearly the end of 2021 in our current forecast. And yeah, thanks.
Deji Naidu, can you deal with Hillary's question?
Thank you, guys. We don't have precise numbers. Anecdotally, we do have been literally tens of per bank for each of the big banks for what I would call loan restructuring arrangements or payment holidays. We're not tracking this on a daily basis, but we are tracking it fairly regularly. On defaults, it is not yet coming through in the numbers. Not yet for missed payments or people paying their installments. End of April, it was largely a smooth run for the banks. Expecting this in the course of the next few months. May, I'm sure there'll be a few more missed payments, similar June, July. So we are expecting this in the months ahead. We're comfortable that the banks are well capitalized, have got adequate liquidity, and are well provisioned for an increase in non-performing loans and increase in defaults at this stage. The regulatory that we've put in place while continuing to play their role in extending credit to the economy. Guarantee scheme. We've asked the big SPA and about how much do you think end of the 100 billion that has been pledged in this first phase has been taken up by commitments in that sense from the big 6 banks and 3 other smaller banks. Not all of the 100 billion, but actually above 90 billion. And so that's an indication from the banks of what they think they would need. The actual drawdowns take place weekly. The scheme was only launched on the 12th. So we don't got very, very low drawdowns to do. But we're on a regular basis. The indications from the banks are that they will need this facility and they think it's quite useful. Thanks, Chair.
Thanks, Kuben. Rashad, I don't know if your microphone is now working. I hope you'll get it. You'll get it working. Lucanio, the question of whether we think that the bank has done enough. As we say, we think that for where we are providing a lot of support to the economy. But going forward, we will continue to be guided by the data of what we see, the risks attendant to our forecast, both for economic growth and for inflation, and we will respond accordingly. What is in no is that having built while the Reserve Bank stands ready to deploy its tools in accordance with our mandate to support households and firms. And that is what we have done, and we were able to utilize our buffers across the instruments that we have, from regulatory to financial policy monetary policy is what we do. The calmness in the financial markets, I'm not sure that I would quite call it calmness, but it is a development that we are no longer seeing the volatility that we saw in March and April. And we just, from where we are standing, are happy that the financial markets continue to function. Hilary, you also asked then the question of bond purchases for May. We released the results on the 7th day following the end of the previous month. So the figures for May will be released on the 7th of June. So that is where we are. We do not release any preliminary figures. And then there was a question on the chart about the forecast for job losses. No, it's true. We do not do a forecast for job losses or even for job creation. What we do know is that job creation comes from economic growth. And when you have an economy that is contracting, it goes without saying that jobs will be shared. How many jobs? We do not know. But Stats SA will, as they release the figures at some stage, give us an indication of how many jobs have been lost. Thank you very much. Any other questions? I don't see anything on the chat. I don't see any electronic hands up.
Governor, if I can just come in.
Yes, Fundi.
On the bond purchase program, and just one thing I wanted to add is that because we are seeking to ensure that markets function, what we pay attention to is whether we see signs of stress, and that might not be the case across the yield curve. So it could be that there is a particular bond around which there's a problem. So these are the things that drive the decisions, and the volume of businesses will vary on a day-to-day basis, depending on what we're observing in financial markets. Towards the end of April, for example, there was some rebalancing by foreign holders of government bonds because we got removed from the World Government Bond Index. And that had a significant impact on the sale of bonds over that period. So depending on what it is that's happening, we might buy more bonds on a particular day or buy fewer bonds on a particular day. Thank you.
I see an electronic hand. Fin24.
Okay, good afternoon, Governor. This is Lamise Umarji from Fin24. I wanted to check if you could weigh in on what the rate cut would mean for consumers. We have been saying that, we can expect some relief, but at the other side of the spectrum, that could be counteracted by retrenchments, during this difficult time. So could the Reserve Bank maybe weigh in on that?
Okay, Lindley.
Thank you, Governor. I just wanted to ask a question around your growth forecast. We've seen some other forecasts suggesting much worse growth figures. Could you just talk to some of the thinking around where you think this contraction is going and why you arguably haven't got a higher figure for the contraction in growth? Thanks.
Okay, Mfuneko.
Hello.
Go ahead, Mfuneko.
Hello, can you hear me?
Yes.
Hi, Governor, and to the MPC. I've got two questions. The first is, how much of the previous put back into the economy? Do you have advice, perhaps? And how much do you see this latest cut adding to economic activity, and through which particular channels do you see that happening? And the second question is, what, if any, risks do you see of asset price inflation as a result of your... Perhaps could you also comment on the steepening of the bond curve? Was that in any way significant in the MPC's considerations, not just for the rate cut, but in other ways that it could possibly influence issues? Thanks.
Okay, Chris Lovald, growth forecasts, and then if you deal with that, and DG Chasivana, you must deal with risks, so asset price inflation, and Kasim, are you there? I want you to deal with means for much has been put back into the economy as a result of the cuts. Shall we start with you, Professor?
Okay, thank you very much. Just to follow up on one question, there was a second part to Claire Bissicker's question about, do we see nominal interest negative? Just to answer that question, I think that the key thing here is that even countries that have very low interest rates, or very low inflation, or in many respects even some deflation, often have a slight positive nominal rate. So I think the key issue here is that, the only time you can think about a nominal negative interest rate is, when you're really going into the domain of deflation, and that's when you start entering that. As far as negative real interest rates are concerned, as Chris outlined, depending on whether you're the quarter ahead, year ahead, we are in negative territory, and that's what we're trying to do at the moment. We are in that space. On the issue of consumption, one of the things is that you may have realized that in a lot of the analysis around the world around COVID-19, policymakers talk about relief rather than stimulus. And often we think of monetary policy as kind of stimulus in a recession where we want to stimulate aggregate demand. We are acutely aware of the fact that by reducing interest rates in the context of the economic lockdown, you may not see the kind of demand you would under ordinary circumstances see. So what are we doing? Essentially, in an economy like South Africa, you have people who borrow at specific interest rates. These are floating, and by reducing the interest rate by 50 basis points now and 100 previously, what we are doing is we're really contributing to helping consumers who have debt with their cash flow. We don't really make a fundamental difference on the employment side. If someone is unemployed, they're unemployed. The whole point about reducing the interest rate is really helping consumers who have income or who have debt, and it's kind of releasing more cash flow for the debt by a low interest rate. Thank you very much. Just one point, Governor. I was on mute when you asked me the question. The one around the CPI. The one thing just to say is that we have a very intense engagement with Statistics South Africa, and like many other statistical agencies, they will have to introduce what in statistical terminology is a term called imputation rules. As data is missing, they will have to find ways and methods of calculating the data. And I can rest assured, I can give you the assurance that Statistics South Africa, at least in the CPI and a few other statistics, some of the best methods to deal with data problems. Thank you.
Thanks, Rashad. Lovald?
Yeah, so on the growth issues, just taking off from where Rashad left off, really, I don't think we have a very clear sense of the channels through which the rate cuts and other actions of the bank are going to contribute directly to growth. Conceptually, I think the idea is much more that it and firms weather the negative economic shocks associated with the lockdown, keep some cash going, keep people jobs, so that when they are better prepared to resume economic activity and take advantage of people going out and spending and new orders being placed by firms in parts of the economy, the global economy, that start to pick up activity. Obviously, low real rates should also send the signal to people that the hurdle rates for investment in the future are lower, and that they should be able to increase credit to achieve those lower hurdle rates some point after the recovery starts. So the question about the V shape and the W shape matters, but we have no control over the way in which those kind of letters themselves out. We could just prepare households by lowering rates and providing liquidity. On the actual growth forecasts, look, I mean, the forecasts out there are very wide ranging, and people have approached those numbers with different kinds of methodologies. Our growth forecasts are based on a supply side view in the near term. So we take a view on the level of sectoral activity by level of lockdown, and then we phase through the lockdown relaxations over on a quarterly basis through time. And that generates a supply side response, which we build back in. There's a demand side component to that, and that's phased in slowly over time as well. So we have a very big negative shock in Q2, but Q3 and Q4 very quickly turn into positive growth rates on the assumption that the lockdown gets phased out over the course of the year. But these numbers are very rough estimates, and that's true of our numbers as it is true of other modelers and forecasters and analysts out there. Thanks.
Thank you, Governor. So, Funeko, on your question around the risk of asset price inflation, let me say that one of the reasons why the SARB intervened in the government bond market was that we were seeing evidence of stress. So in some instances, we had too few buyers that were there in the market, and these limited buyers were setting the price. And we intervened to ensure that there is proper functioning of the market and that there's sufficient price discovery and that there was an adequate number of sellers and buyers in the market. So this is the role that we envisage as playing as the SARB to ensure that the markets function properly. So in this regard, I would say that the risk of asset price inflation through our activities is fairly limited. So we are not creating additional demand, and our action have not certainly spurred on an additional or less supply of government bonds in the market, buying what the market is supplying. And as I highlighted earlier, we are driven by signs of stress that we are observing in the market, and we vary our actions according to that. You asked also a question around the steepness of the yield curve. So as the SARB, when we set out in these operations, we're not really worrying about the steepness of the yield curve or the price that is set in the market, because that is largely driven by something that's out of our control. So part of the driver of the steepness of the yield curve is also government issuance. And so I think that the steepness of the yield curve is reflecting a number of factors. It's reflecting the market's assessment around credit risk, and it's also reflecting the issuance as well. and it's also reflecting the
thank you, Fundi. Mfuneko, do you want to come back again? Or is that the previous hand? Okay.
Yes. Yeah, just
yes, yes, that was the previous hand. Or yes, I have a question.
Discussion or consideration of further rate cuts and how that might impact how the SABC sees the economic situation evolving.
Or future rate cuts, holds or hikes. If you wait until the next MPC meeting, you will know which way we go. Well, if there aren't any other questions, thank you very much, ladies and gentlemen. That concludes the business of today. We will see you in July.
Thank you, members of the media.